Are cracks forming beneath the surface of the stock market, as this article indicates? And should you be worried? The stock market is being driven higher by a few large companies, and the smaller companies that make up the S&P 500 are not advancing. This is causing a current divergence in the direction of the S&P 500 versus the advanced decline line, as you can see here. There's a quote attributed to Mark Twain that goes something like this: "There are three kinds of lies: lies, damn lies, and statistics." Yes, there's a divergence recently, as shown in this chart right here. And the writer of this article also highlights the same type of divergence back here in late 2021, right before the Fed started raising interest rates like a maniac. And you can see how the market fell. So what does this current divergence mean, and should we worry about the health of the stock market this time? Look, I'll agree that the breadth of the stock market move is an indication of how strong it is, but these types of indicators have to be taken in context. But what about divergence in these two indicators back here at the beginning of 2024? So if we look here, the S&P was moving higher, and the advanced decline line was moving lower. And what happened right after that? Market went up a lot. And then if we look back here in April, May of 2023, you can see we again had a divergence. And you can see that what happened after that? The market went up a lot. So are statistics being used to manipulate you into reading this article? First of all, I agree that the recent upward moves in the S&P 500 and NASDAQ 100 are concentrated in a few of the largest stocks. But does this make sense, and why? Well, as I've discussed in my previous video titled, "Why You Should Stop Investing in the S&P 500 Now," link in the pinned comments below, both the S&P 500 and NASDAQ 100 are market capitalization weighted. That means that the largest market cap stocks are weighted in proportion to their market caps, so the more successful companies will dominate the index, while the smaller, less successful companies will fade in their contribution to the index. And you can see that here. Here are the companies of the S&P 500, and you can see that Microsoft is currently the largest, and it's weighted at 7% of the index, followed by NVIDIA, followed by Apple and Amazon and so on. And you can see how quickly these fall off. And that means that these companies down here have much less effect on the S&P 500 than the ones right here at the top. And if we look at the NASDAQ 100, that's even more pronounced. Microsoft is 8.5% of the NASDAQ 100. NVIDIA's 8.13%, Apple's 8%, Amazon 5%, Meta 4%, and so on. Look, we're currently in an unprecedented, and by the way, I hate that word ever since COVID, unprecedented time where there's a convergence of multiple technologies causing a sea change in the way the world works. And you know what? Most people don't even realize this is happening. Many of my very smart and very well-read friends are totally oblivious. And what are these areas? Well, electric vehicles, clean power generation, robotics, 3D manufacturing, the genomics revolution, just to name a few. But at the center of all these new technologies is artificial intelligence. So what do all these index-dominating companies have in common? And will the lesser, smaller companies ever benefit from these new technologies just on the horizon? Or will they just fade away into oblivion? The answer might just surprise you. Look, there are two ways companies can benefit from this coming sea change in technologies, and they're both driven by artificial intelligence, or AI. First, most of the larger companies currently dominating the S&P 500 and NASDAQ 100 that I'm showing you in these lists are able to greatly increase revenue and earnings by offering AI-driven products and services to their customers. Second, many of the smaller companies can and will benefit from the productivity increases that AI and these other new AI-driven technologies afford. Look, AI is currently able to improve productivity by huge leaps and bounds. Several software developer friends of mine have told me they were able to complete software development projects in about 4 hours, and previously those projects would have taken them 4 weeks to complete without the help of AI. We've never seen those magnitudes of productivity improvement in our entire history. There is a dark side to this, however. Some of the legacy companies, especially in the S&P 500, will either no longer exist 5 to 10 years from now, or they'll just be unrecognizable shells of what they are today. So, should you be worried about the performance of the stock market, as this article suggests? The obvious beneficiaries of this AI-driven sea change in technologies are many of the largest market cap companies like Microsoft, Amazon, Nvidia, Google, Tesla, and possibly Meta. Notice I didn't include Apple. That'll be a topic of another video about Apple losing its luster and ability to innovate. The savvy investors have figured this out already. And look, they have been and will continue to concentrate their holdings in these large beneficiaries of the coming technology sea change storm. Wow, that was a mouthful. Do you think the current market is at risk of a substantial decline? Or do you see the huge revenue and profit growth possibilities caused by this current technology revolution? Please leave a comment below. Another great saying that I love: believe half of what you see and none of what you hear. These mainstream media articles and shows try to hook you into viewing their content by getting you to be afraid. Almost none of us have the time to stop and research what they're saying, which is why I publish my market review videos every week. With all that being said, let's take a look at the current health of the stock, bond, gold, and crypto markets. So if we take a look at the equity markets over the past 5 days, you can see we've had a very healthy rally here. Now, it kind of fell off on Friday with the jobs report, but this looks really good. You've got ARK Invest up at the top, right up there with the NASDAQ, followed by the S&P, followed by the Dow. Now, we'll talk later about why small caps are really underperforming here. And I think it'll make sense when we get there. Let's look over the last month. If we look at the last month, it's been kind of wishy-washy, but I like the fact that the NASDAQ is up here on the top, followed by the S&P. Now, the Dow, small caps, and ARK are all down here with losses. What about year-to-date? Well, year-to-date, we have, again, a fairly healthy rally with ARK Invest really bringing up the rear end here. And I think, again, like small caps, there's a very good reason for this. And I think once this turns, this is going to be one heck of a ride higher. And what about over the past year? Well, again, NASDAQ on top, S&P, Dow, small caps, followed by ARK Invest. And how does this all show up in the bottom dynamics? Well, if we take a look at the bottom dynamics, you can see that, as I mentioned last week, the confidence level, this dashed line, has been falling. It's at a fairly low level here. And you can see that the S&P 500 has been kind of going slightly higher, but nowhere, kind of sideways to slightly higher. And we had an attempt at a bottom confirmation here, this blue line, but you can see that absolutely cratered on Friday when the jobs report came out. Now, the confidence level is tilting up a little bit here. I don't know what to read into that. You know, I view the jobs report as kind of what I call a noise/news event that causes the market to make these big gyrations. And then you get these big perturbations in the metrics. So don't know what to read into that right now. But let's take a look at risk versus opportunity. So if we look at risk versus opportunity, this is really a set of mixed signals here. You can see that risk acceleration, this yellow line, has pulled way back here. It's below 60, which is where I like it to be. But it is moving higher as of Friday. Now, again, Friday had a big move because of the jobs report. And you can see that risk, the red line, is also tilting higher as of Friday and is up here at 70, which is not a good place. Now, what's kind of balancing this out, though? Well, if we take a look at opportunity acceleration, that's up here above 60 and moving higher, so that's good. And the opportunity level, which is very much a lagging indicator, you can see has been steadily moving higher. So kind of a mixed bag here. Nothing really solid. And what if we look at equity versus safety? Well, let's jump right into the overlays. So you can see kind of what's going on here. As you saw in the graphs of how the markets performed over the last week, month, and so on, you can see that the NASDAQ 100 is right up here in first place. This looks great. And just as you saw in those same charts, the small caps have been really falling off here. The small caps are down here in 8th place. Now, what I don't like about this is that cash is stubbornly up here in 3rd place. And if we overlay the S&P and the Dow, you can see that the S&P has pulled back. The Dow has moved up a notch. Not really a lot going on here. What's really interesting here, though, is to take a look at safe haven assets. I love the fact that gold has plummeted to 10th place. So no fear of inflation, no fear of geopolitical risks. I also like the fact that EDV, the longest duration treasuries, are ahead of 20-year bonds, are ahead of intermediates, are ahead of short duration treasuries. So this is a healthy relationship for treasuries as long as they pull out of that dive bomb on Friday after the jobs report came out. And how does this all show up in the buying and selling pressure? Well, if we look at the buying and selling pressure, you can see the Dow has really kind of gotten wrecked here. You can see that the selling pressure was through the roof, but it has since collapsed and the buying pressure is coming up as the price moves higher. So this is encouraging. S&P 500, you can see the buying pressure moving higher as the price moves higher. This is also encouraging. In fact, the buying pressure moved up on Friday as the market fell. Same with the Dow. So that's very encouraging going forward. What about the NASDAQ 100? Well, the NASDAQ 100, the buying pressure is still below the selling pressure, but you can see it also continued moving higher on Friday when the market pulled back. What about small caps? Small caps, not so much. Look at this. You can see the decline in price, a big decline on Friday, and you can see that the selling pressure is moving higher. How about ARK Innovation? Well, similar to the small caps, you can see we had a rally attempt here. You can see the selling pressure really fell off, but then on Friday, the price dropped quite a bit. But what's interesting is the selling pressure just kind of flatlined, and the buying pressure kind of moved up slightly. So this doesn't look terrible. Now let's take a look at sector rankings. Now I show these briefly because they tend to be very much in the rearview mirror, but I do like the fact that cash moved down here. I like the fact that consumer staples moved down. But let's jump into sector rank acceleration because these give you more of a sense of where things are headed rather than where they've been. And you can see here, well, let's do an overlay. Let's look at what's good in these two tables. So we've got last week up here in the top and this week in the bottom table. So if we look at what's good, there's a lot to talk about here. Amazing amount. In fact, you can see I've put green lines or kind of yellow-green lines on everything that I think is good here. Obviously, I like the fact that gold has pulled back. I like the fact that emerging companies have both moved up from last week to this week. Innovation, ARK Innovation, moved from down here all the way to up here. The Dow moved up. The NASDAQ 100 moved up. The S&P 500 moved up. Emerging markets moved up. Technology, semiconductors moved up. And clean energy, which is an up-and-coming technology, also moved quite a bit higher. And normally I wouldn't like the fact that utilities are up here in first place. But if you think about it, that's in response to the whole AI revolution because it takes oodles of electricity to power all of this AI compute power. And that's why utilities are up here. And that's why clean energy is moving up this way. Now, what could be considered negative in here? Let's overlay the yellow lines. There's not even any red lines here. But you can see that cash has moved up, and you can see the consumer discretionary has kind of stayed put. I'd like that to move up eventually, and it will if this continues, but really not too much And how do treasuries look? Well, they looked fabulous up until Friday when that jobs report came out. And you can see they just got bludgeoned on Friday. Really dropped a lot here. In fact, I think EDV was down almost 3% on Friday, which is insane. Over the last month, you can see that here. You can see we had a very nice rally, and then the jobs report came out. What about year to date? Well, year to date, we're kind of, we're not even back to zero yet. And, this will have to go up about probably guessing 12% to get just back to zero. And then if we look back over the past year, you can see that currently EDV is down at almost about 15%. So it's going to have to go up, I'm guessing, somewhere around 18% just to get back to zero. And how does all of this show up in the buying and selling pressure for treasuries? Well, you can see that short duration treasuries have, in general, over the past couple of months moved higher, but the selling pressure is moving sharply higher here as of Friday because of the jobs report. Similar picture here with intermediate treasuries, big pullback in price, big drop in buying pressure, big increase in selling pressure. What about 7 to 10 year treasuries, what I call sort of intermediate to long treasuries? Same kind of picture, big drop in price, dropping buying pressure, although it's still above the selling pressure, which is good. And then if we look at the long bond, 20-year treasuries, similar here to 7 to 10 years, drop in price, drop in buying pressure, but you can see that the buying pressure is still well above the selling pressure. So hopefully these start moving back up next week. And what about the inverted yield curve? Well, not much movement here. It's kind of pretty much stuck where it was last week when I produced this video. And you can see we're still 45, almost 46 basis points inverted. So not a lot of movement there. And what's really going to uninvert this is the Fed lowering rates at the short end here. That's where they control things. And speaking of the Fed, let's take a look at the Fed rate monitoring tool. And if we look at this, these numbers got much worse on Friday. But you can see that there's still almost 100% likelihood that when the Fed meets next week, that they'll leave rates right where they are. What's interesting is this is so high now. This was much lower, as you can see here, just a day ago before the jobs report came out. This was only at 78% likelihood. Now it's at 91%. And again, in September, similar picture, right? This was at 32% likelihood that rates would stay the same and a much bigger likelihood that the Fed would lower rates. Now, what I do like about this is that this is still less than 50%. So there's more than a 50% likelihood that the Fed will lower rates when they meet in September. Now, these numbers can change a lot, and we'll see how things go over the next few months. And what about gold? Well, gold absolutely got trashed. I mean, look at this. You can see a big drop back here, a huge run up in selling pressure, kind of noodled sideways, and then another huge drop here and a big spike in the selling pressure. So it looks like investors are shying away from gold because they don't see inflation risk and they don't see geopolitical risk. And what about Bitcoin? Well, Bitcoin has been kind of on a nice gentle rally here, although you can see it's kind of flat topped a little bit more recently. And the buying and selling pressure has just been kind of noodling and trading places here. So not a lot to see yet, but we'll just have to wait and see how this one plays out. There's a lot going on with Bitcoin in the governments and in the markets. If there's one thing to take away from my market reviews over the past several weeks, it's that the equity and bond markets have been volatile, but no one has a crystal ball. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below. titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.